Hello everybody, I'm delighted to be here today to talk about cryptocurrency regulation. Today's webinar is the first of 7 webinars I'll be doing over the next few weeks, covering virtual asset regulation and international regulatory efforts, Hong Kong's crypto regulatory regime and how it compares to the regulatory regimes of some other jurisdictions. In today's webinar, I'll be providing an overview of the different regulatory approaches taken by regulators with respect to cryptocurrencies and an introduction to Hong Kong's regulatory approach, before transitioning to a discussion of the development of cryptocurrency over the years. I'll then finally look at the Financial Action Task Force, FATF Standards, on anti-money laundering, AML, and counter-terrorist financing, CTF, and the revised recommendations extending AML and CTF obligations to certain activities in cryptocurrencies. So, except in relation to anti-money laundering and counter-terrorist financing, where FATF has imposed requirements, there's been no coordinated approach to the regulation of cryptocurrencies. Instead, jurisdictions have developed their own approaches depending on whether they perceive cryptocurrencies as involving unacceptable risks or opportunities for innovation. Additionally, there is the lack of standard terminology across jurisdictions and official statements. The terms cryptocurrency, virtual currency, digital currency, virtual assets, digital assets, crypto assets, and digital tokens are used more or less interchangeably. For the purposes of this webinar, I'll be using the term cryptocurrency to cover all of these terms. So, jurisdictional approaches to crypto regulation fall into 4 broad categories. The first is that adopted by a small number of countries, including Saudi Arabia and Afghanistan, which have banned cryptocurrencies outright. The second approach is to severely restrict the use of cryptocurrency. For example, China, which prohibits the trading of cryptocurrencies and their use for payment, as well as ICOs. The third category comprises countries that have created specific regulatory frameworks for cryptocurrencies, for example, Japan, Malta, and Thailand. However, the regulation that's been introduced relates mainly to imposing licensing requirements on crypto intermediaries. That's the entities that trade or provide other services in relation to cryptocurrencies. Finally, the last category of jurisdictions, which is the majority, are those like Hong Kong, the US, and the UK, which regulate cryptocurrencies to the extent they fall within existing categories of regulated financial instruments, such as securities, commodities, or e-money. Some of these regulatory authorities have issued guidance classifying cryptocurrencies according to their characteristics and economic purpose, such as the UK Financial Conduct Authority. As I'll be discussing, this approach has advantages. Adopting a wait-and-see approach to cryptocurrency regulation allows this emerging asset class to develop, while knee-jerk imposition of regulation risks stifling innovation, as has been seen to some extent in the US. The downside of trying to regulate cryptocurrencies under existing regulatory frameworks is that shoehorning these very diverse assets into categories of investments created many years ago for traditional investments has led to a lot of uncertainty as to how the regulations apply. There are arguments for a more nuanced approach to regulating cryptocurrencies. The IMF published a report on crypto regulation in December 2019, recommending that while cryptocurrencies continue to evolve, regulatory authorities should consider pursuing a proactive and holistic approach to regulation based on a comprehensive assessment of the risks. The report outlines the IMF's view that there is a need for international cooperation in the crypto space and the need for risk-based and proportional regulation. Part of the difficulty facing regulators is the speed of evolution in cryptocurrencies and their uses, which is being driven by factors as diverse as customer preference regulation, competition, developments in technology, speculation and privacy, and security concerns. Bitcoin, the first ever cryptocurrency, was launched in January 2009 as an alternative means of payment and has evolved into a store of value, hedging, and a speculative investment tool. As those of you who follow Bitcoin prices will know, 2020 was quite a year. The turmoil that hit financial markets in March 2020 delivered one of Bitcoin's worst months on record, with prices falling to around $3,600, which was Bitcoin's worst month since the crash at the end of 2018. It was all up from there. On the 16th of December 2020, Bitcoin's price passed $20,000 for the first time ever, a surge of more than 400% from the March low point. And as you may know, on the 3rd of January 2021, Bitcoin reached an all-time high above $34,000. Its soaring valuation is being attributed to increasing institutional interest as investors hedge against inflation. This also comes against a backdrop of US dollar weakness, US-China tensions, and of course COVID-19, leading cryptocurrency advocates to dub Bitcoin the new gold, after periods when both rallied in tandem. There are now approximately 8,164 cryptocurrencies with a total market cap of over $893 billion as at the 4th of January this year. These include payment tokens, ICO tokens, stablecoins, security tokens, and more. The largest by far is Bitcoin, which with a market cap of over $614 billion on the 4th of January 2021 is now more valuable than many publicly traded companies. 18.5 million Bitcoin were in circulation, and 24-hour trading volume was over $81.6 billion on the 4th of January 2021. Ethereum and Tether ranked second and third with a market cap of $116.5 billion and $21.3 billion respectively on the 4th of January 2021. The number of consumers holding cryptocurrencies has also risen significantly, with the highest rates of cryptocurrency ownership and use found in Africa, particularly Nigeria, and South Africa, Latin America, where Brazil, Colombia, and Mexico have crypto adoption rates of between 18 and 20%, and Asia, particularly Vietnam, according to a recent survey by Statista. The high cost of transferring money cross-border has led many offshore workers to turn to cryptocurrency exchanges to send funds back to their families. Currency instability is also driving cryptocurrency adoption in Africa and Latin America. The lowest rates of crypto use are in English-speaking and European countries. The Bitcoin ATM industry has grown since April 2019. 1,200 new Bitcoin ATMs were installed worldwide between January and April 2020, bringing the total number to 7,500, and as of the 1st of November 2020, this number had reached 11,497. In a further sign that cryptocurrencies are entering the mainstream, institutional interest in cryptocurrency has skyrocketed in 2020. In July, Fidelity reported that some 36% of institutional investors worldwide own crypto, while 60% were actively looking at crypto investment, with Evertas, the world's first crypto asset insurance company, attributing the increase in institutional interest to an improved regulatory environment, more mainstream fund managers, financial services companies entering the crypto market, and increased choice in terms of crypto asset-focused investment vehicles, to name but a few factors. JP Morgan's Global Markets Strategy Report, released in October 2020, further suggests that corporate endorsement of cryptocurrency, in particular PayPal, is propagating demand. And this is supported by the finding that 0.5% of all Bitcoin in circulation is held in the treasuries of publicly traded companies, notably New York Stock Exchange listed Square Inc. and NASDAQ listed MicroStrategy. Square Inc. recently allocated 1% of its total assets into Bitcoin, and MicroStrategy invested $425 million in Bitcoin and made it the company's primary treasury reserve asset. So what do the levels of institutional holdings look like to date? Well, Coinbase, a US-based crypto exchange, found that their institutional assets under custody have grown threefold since April 2020, from $6 billion to $20 billion as of November 2020. And JP Morgan's calculations indicate that Bitcoin currently accounts for around 0.18% of family office assets. This compares to 3.3% for gold ETFs. JP Morgan has even gone so far as to suggest that gold may suffer for years because of the rise of cryptocurrencies, a trend that's already unfolding. For example, the Grayscale Bitcoin Trust has seen significant inflows, around $2 billion since October 2020, compared to outflows of $7 billion for ETFs backed by gold. Meanwhile, according to a 9th December 2020 press release, Standard Chartered, in collaboration with Northern Trust, are launching a cryptocurrency custody solution tailored to institutional investors, known as the Zodia Custody, a platform which aims to enable institutions to invest in crypto assets. The platform is expected to launch in London in 2021. We've also seen a number of traditional finance players launching cryptocurrencies. JP Morgan, long a staunch critic of crypto, became the first US bank to launch a cryptocurrency in February 2020 with the launch of its JPM coin, which is pegged to the US dollar. Unlike Bitcoin, the JPM coin operates privately and enables instantaneous international payment transfers between its institutional clients, replacing wire transfers. Goldman Sachs is reportedly looking to follow JP Morgan's lead with the issue of a Goldman coin, following the firm's recent appointment of a new global head of digital assets, who envisages that crypto will cause a radical shake-up of traditional finance within 5 to 10 years. All financial assets and liabilities on blockchain, and everything that today is done physically being done digitally, creating huge efficiencies in debt issues, loan origination, IPOs, and securitization. Interest in decentralized finance, or DeFi, has surged in 2020. The opposite of traditional centralized finance, or CeFi, DeFi is disrupting traditional market activities such as lending and securities trading by removing the intermediaries, brokers, banks, etc. Instead, transactions are conducted on decentralized open source networks using smart contracts, cutting costs and improving security. An example of a DeFi project is MakerDAO, a decentralized finance platform that allows borrowers to provide cryptocurrencies as collateral for loans of stablecoins called DAI that are pegged to the US dollar. According to statistics from DeFi Pulse, over $7.7 billion is tied up in the DeFi market, with about $4 billion of that having been added in the past few months. Many of the DeFi products facilitate lending and borrowing. Others, such as Uniswap, are automated market makers, smart contracts that create a liquidity pool of tokens that are automatically traded by an algorithm rather than an order book. Interest in stablecoins has surged during the pandemic, making them a key driver of mainstream crypto adoption. A stablecoin is a cryptocurrency designed to be resistant to the price volatility associated with cryptocurrencies such as Bitcoin and Ether. Typically, stablecoins are backed by a reserve of real assets, typically fiat money such as US dollars, or a basket of currencies, bonds, assets like gold or oil, or a mixture of assets. Examples include Tether's USDT, which claims to be fully backed by US dollars, and CNH, Tether's offshore Chinese yuan-backed stablecoin. The value of these stablecoins is locked relative to the reserve currency. Between March and July 2020, the number of stablecoins doubled to 12 billion, having taken 5 years to reach 6 billion in March 2020. US dollar-backed stablecoins in particular saw a boom in this period. The market cap of Binance USD, for example, rocketed 176% to $188 million in the first 27 days of March 2020. The success of stablecoins this year has been boosted by the volatility of traditional asset prices. But how they fare once volatility subsides obviously remains to be seen. 2020 has seen a number of developments in stablecoins, with many tapping into the e-commerce space. The end of August 2020 saw the first e-commerce payment using a bank-issued stablecoin, Signum, Bank's digital Swiss franc, DCHF, which was used to make a payment on Galaxus, a leading Swiss online retailer. JP Morgan's JPM coin is another example of a stablecoin. On September 9, 2020, Finality, a stablecoin project across 13 global banks spearheaded by UBS, under development for over 5 years, predicted that it will receive regulatory approval for its Unity settlement coin by the second quarter of 2021. The project aims to establish a network featuring tokenized US dollars, Japanese yen, euros, Canadian dollars, and British pounds sterling. Facebook's planned launch of Libra, a global digital currency backed by different currencies and government debt, was supported originally by over 20 companies, including Visa, MasterCard, eBay, and Uber. However, it ran into problems with regulators, which resulted in some of its biggest backers dropping out. The original proposal was subjected to intense regulatory scrutiny, given the possibility of Facebook's 2.5 billion users adopting the cryptocurrency, threatening regulators' control over money. In an effort to woo regulators, the original plans were scrapped, and the planned Libra 2.0 is reportedly planning to launch as early as this month. Reportedly a single coin backed one-for-one by the US dollar, it will launch in early 2021, with other currencies and the composite launching at a later date. Launch is, however, subject to regulatory approval by the Swiss Financial Markets Supervisory Authority, so it's really wait and see right now. Central bank digital currencies, or CBDCs, are another major development which, if they come to fruition, may eliminate the need for stablecoins. The International Monetary Fund's survey of CBDC research published in June 2020 noted that the primary objectives of central banks exploring the potential issue of a CBDC are improving financial inclusion and maintaining the central bank's relevance in the monetary system. Other objectives include reducing costs and increasing the efficiency of payment systems. China looks set to be the first to launch a digital version of its national currency. The People's Bank of China began trials of China's digital yuan in 4 major cities in April 2020, and it was recently reported on the 17th of December 2020 that Hong Kong's HKMA is in talks to pilot test China's digital yuan. This would be quite significant if it goes ahead, as it would be the first time that the digital yuan would be used outside the mainland and the first application of the digital yuan to cross-border payments. However, China's digital yuan differs from typical cryptocurrencies in that it's not a separate currency on a decentralized market. Rather, the digital yuan will represent the digitalization of a portion of China's monetary base. The Chinese government is also reported to be planning a stablecoin backed by a basket of 4 Asian digital currencies, the yen, won, yuan, and Hong Kong dollar, to stimulate trade among China, Japan, Korea, and Hong Kong and improve cross-border payments. Turning now to virtual asset regulation. And moving on to how cryptocurrencies are regulated. Regulators have generally been fairly slow to regulate this space. This is despite a number of concerns related to the risks associated with cryptocurrencies and the general perception of the potential for the distributed ledger technology underlying cryptocurrencies and cryptocurrencies themselves to deliver significant benefits. As the IMF report on crypto regulation highlights, regulation needs to be considered in the light of the risks associated with cryptocurrencies, risks which I will briefly outline. Firstly, fraud. Widespread fraud was a major factor in China imposing a ban on ICOs in September 2017. A statement on the website of the People's Bank of China claimed that around 90% of ICOs conducted were fraudulent, and in 2019, China saw a $42 billion Bitcoin scandal play out. The Plus token scandal, a scandal that was estimated to be worth, as I just said, $42 billion. Meanwhile, in the UK, the High Court ordered the closure and winding up of GPay, a cryptocurrency platform which scammed traders through fake celebrity endorsements. It was reported that GPay had lost 1.96 million of investor funds. Secondly, there's the risk of financial crime, the risk of cryptocurrencies being used for money laundering and terrorist financing. However, the Financial Action Task Force, FATF, noted in its June 2020 report that use of cryptocurrencies in detected money laundering and terrorist financing cases is relatively small, compared to the use of traditional financial services and products. Thirdly, security and security breaches are a key concern. Cyber attacks resulting in crypto exchanges being hacked and cryptocurrencies being stolen are common. Japan, one of the world's most active markets for cryptocurrency trading, has experienced a series of major hacks, resulting in the theft of around $580 million worth of cryptocurrencies from the Japan-based CoinCheck and Xife exchanges in 2018. In 2019, more than $290 million worth of cryptocurrencies and over 500,000 customer user logins were stolen from cryptocurrency exchanges worldwide. Cryptocurrencies also bear the risk of mis-selling and other market abuse activities such as pump and dump schemes. There's also the general risk of failure. Many ICO issuers are startups which have, in any event, a high failure rate. Consumer protection concerns have focused on the quality of information provided to investors and whether ICOs are suitable investments for retail investors. And finally, which I'm sure we're all well aware of, volatility. For example, Bitcoin's price reached a high of $19,665 in December 2017, up 1,824% from its price at the start of 2017, and then crashed to just $4,000 by the end of 2018. On the other hand, cryptocurrencies offer significant benefits. Virtual assets, which act as a means of exchange, such as Bitcoin, can provide more efficient and cheaper transactions, such as in international transfers. As originally conceived by Satoshi, Bitcoin was intended as a purely peer-to-peer version of electronic cash that would allow online payments to be sent directly from one party to another without going through a financial institution, according to Bitcoin's 2008 white paper. Published during the 2008 global financial crisis, Bitcoin's white paper offered up an alternative to the traditional banking sector and financial access for the world's unbanked populations. The World Bank's latest, that's 2017, Global Findex database found that 1.7 billion adults don't have a bank or financial services account, although around 2/3 of them own a mobile phone. Bitcoin was thus envisaged as a means of providing a cheap and fast payment mechanism which could operate cross-border with far greater efficiency than was possible through traditional banks, while eliminating the possible risk of a failure of the financial system. Satoshi did not, however, foresee that Bitcoin would become a store of value or investment which people would buy for speculative purposes rather than its use value. The different uses of virtual assets and the fact that their actual use can be very different from the use intended by their creator are among the factors making the regulation of virtual assets so challenging. Also, when used as a capital raising method in ICOs, virtual assets can support innovative business models, which may have access to traditional fundraising avenues. The most significant regulatory development to date comes from FATF, the set of international standards on AML and counter-terrorist financing. FATF has revised its recommendations, the global standards on AML and CTF, to explicitly require member countries, including Hong Kong, to regulate virtual asset service providers, or VASPs, for AML and CTF purposes. License or register VASPs and subject VASPs to effective systems for monitoring and supervision. That was under the revised FATF Recommendation 15. As of June 2020, 32 regulatory authorities had introduced regulation of VASPs. 3 had prohibited VASPs and 19 had not yet implemented a VASP regulatory regime. In Hong Kong, the Financial Secretary's 2020 to 2021 budget speech said that the government would consider extending Hong Kong's AML-CTF regime to cover virtual asset service providers as required by the FATF's recommendations. The FSRBs subsequently published a consultation on the 3rd of November 2020, outlining proposals to introduce a new licensing regime for virtual asset exchanges under Hong Kong's anti-money laundering legislation, the Anti-Money Laundering and Counter-Terrorist Financing Ordinance. This new regime would require the licensing of virtual asset exchanges that are not currently required to be licensed under the Securities and Futures Ordinance. That's because they trade virtual assets which are not within the statutory definitions of securities or futures contracts. At the moment, the AMLO only applies to financial institutions, including HKMA authorized institutions such as banks, and SFC licensed corporations and designated non-financial businesses and professions such as lawyers, public accountants, and trust and company service agents. Unless they're licensed by the SFC, cryptocurrency exchanges and OTC trading desks are not currently subject to the AMLO. For those of you joining for session 2 next week, we will explore this in more detail then. So let's take a look at some key definitions before I dive into the substance of the FATF recommendations. First, virtual assets. FATF defines a virtual asset as a digital representation of value that can be digitally traded or transferred and can be used for payment or investment purposes. This definition explicitly excludes digital representations of fiat currencies, securities, and other financial assets that are already covered elsewhere in the FATF recommendations. Secondly, VASPs. FATF defines virtual asset service providers as any person who's not covered elsewhere in the recommendations and conducts any of the following activities as a business on behalf of another person: exchanges, virtual assets and fiat currencies; exchanges, different forms of virtual assets; transfers virtual assets, that is, conducts a transaction that moves a virtual asset from one virtual asset address or account to another; provides safekeeping and or administration of virtual assets or instruments, enabling control over virtual assets; and participating in and providing financial services related to an issuer's offer and or sale of a virtual asset. VASPs therefore include cryptocurrency exchanges, providers of certain types of crypto wallets, and providers of financial services for ICOs. In June 2019, the FATF updated its guidance on virtual assets and related service providers and issued an interpretive note to Recommendation 15 on new technologies, clarifying how its AML and CTF standards apply to virtual assets, which I'll take a look at in more detail now. INR 15 imposes binding measures on member countries for the regulation, supervision and monitoring of virtual asset service providers. In particular, it requires countries to apply a risk-based approach to financial activities involving virtual assets and VASPs to ensure that measures to prevent or mitigate money laundering and terrorist financing are commensurate with the risks identified. Countries should require VASPs to identify, assess, and take effective action to mitigate their money laundering and terrorist financing risks. Require the licensing or registration of VASPs, incorporated or establishment in their jurisdiction, and natural persons who carry on VASP business in their jurisdiction. Jurisdictions may also require the licensing or registration of VASPs which offer products and or services to customers in or conduct operations from their jurisdiction. Thirdly, ensure that VASPs are subject to adequate regulation and supervision or monitoring from an AML-CTF point of view, and that VASPs effectively implement the relevant FATF recommendations. VASPs should also be subject to effective systems for monitoring and ensuring their compliance with national AML-CTF requirements and should be supervised by a competent authority. Apply all AML measures, including, without limitation, customer due diligence, record keeping, suspicious transaction monitoring, to VASPs. Customer due diligence is required for transactions above $1,000 or 1,000 euros. Designate a competent authority, not a self-regulatory body, to be responsible for VASPs licensing or registration, monitoring and supervision. Require competent authorities to take necessary legal or regulatory measures to prevent criminals or their associates from holding or being the beneficial owner of a significant or controlling interest or holding a management function in a VASP. And take steps to identify persons carrying on activities in virtual assets without the necessary license or registration and impose appropriate sanctions. Empower competent authorities to ensure VASP's compliance with AML and CTF obligations, including the authority to conduct inspections. Compel the production of information and impose sanctions, and have a range of effective, proportionate and dissuasive sanctions to deal with VASPs that fail to comply with their AML-CTF obligations, including powers for supervisors to withdraw, restrict or suspend a VASP's license or registration. Sanctions should apply to VASPs, their directors and senior management. FATF also allows countries to prohibit virtual asset activities or VASPs to support other policy goals, such as consumer protection and monetary policy. The FATF recommendations don't apply to a person who's not engaging in the various activities as a business for on behalf of someone else. So an individual who uses virtual assets to buy goods or services for themselves is not a VASP. Also, depending on a jurisdiction's own laws, a virtual asset trading platform may not be a VASP if it simply provides a forum for buyers and sellers of virtual assets to post bids and offers, and the parties trade at an outside venue, such as through individual wallets or wallets not hosted by the trading platform. However, if the platform facilitates the trade by buying the virtual assets from the seller and selling them to the buyer, it will be conducting exchange and or transfer activity as a business on a customer's behalf and will therefore be a VASP subject to the requirements. Closed-loop items that are non-transferable, non-exchangeable and non-fungible, such as airline miles and credit card rewards, are also outside the scope of the VASP regulatory controls. Turning now to one of the most controversial provisions, the travel rule. This requires countries to ensure that originating VASPs obtain and hold the required originator and beneficiary information, including the name and account number of the originator and beneficiary and the originator's identification number. Transmit the information to the beneficiary VASP or financial institution if there is one involved, and make the information available on request to the appropriate authorities. To comply with the travel rule, VASPs need to be able to identify when they are transacting with another VASP, as opposed to a private wallet, and whether the counterparty VASP is licensed or registered in a jurisdiction and adequately supervised for AML-CTF purposes. Conducting timely counterparty due diligence in a secure manner is proving to be a challenge, and one suggestion is for the creation of a global list of VASPs, which would be accessible through a central database or through an API, which connects to each jurisdiction's list. The creation of a global list raises a number of challenges, such as who would be responsible for ensuring the accuracy and security of the information. Another difficulty is that peer-to-peer transfers not involving a VASP or financial institution are not explicitly subject to AML-CTF obligations, leaving VASPs uncertain as to how they should transact with private or unhosted wallets. The FATF June 2020 report notes that there's been less implementation of the travel rule than other AML-CTF requirements, and that several jurisdictions saw the travel rule as a significant challenge to implementing the revised recommendations. FATF, however, did not consider the issues raised around technology solutions to be fundamental barriers to adopting the travel rule. When the FATF revised its recommendations to cover virtual assets in June 2019, its expectation was that member countries should apply them promptly to virtual asset activities and service providers. In its 12-month review of the implementation of the recommendations published in June 2020, the FATF noted that 24 FATF members and 8 members of FATF-style regional bodies had introduced a regulatory regime regulating VASPs, and 1 FATF member and 2 FSRBs had prohibited VASPs. 19 jurisdictions, that was 13 FATF members and 6 FSRB members, had not yet implemented a regime regulating VASPs. Most jurisdictions which have introduced new legislation to regulate VASPs did so by adding VASPs as an obliged entity under their existing law. An example of regulation aimed at FATF compliance is the European Union's 5th Money Laundering Directive, which requires virtual asset service providers to be registered and meet the requirements of the EU's anti-money laundering regime. EU member states were required to implement the requirements of the 5th Money Laundering Directive into local law by the 10th of January 2020. Subsequently, the 6th Anti-Money Laundering Directive entered into force. Member states were required to transpose the 6th MLD into national law by the 3rd of December 2020, while all relevant financial institutions have 6 months, that's up to the 3rd of June 2021, to implement it. The main updates to the AML regime under the 6th MLD include a harmonized definition of money laundering offences, an enhanced definition of criminal activity which has been narrowed down to 22 predicate offences which enable more serious crimes such as money laundering or terrorist financing, an increase in the minimum prison sentence for natural persons for money laundering offences from 1 year to 4 years, and the extension of criminal liability to legal persons. This means that organisations operating in EU member states may be held criminally liable for failures to prevent illegal activity conducted by a directing mind within the company. The sanctions and penalties include disqualifications from commercial activities, undergoing judicial supervision, and temporary or permanent closure of establishments. The 6th MLD also encourages the member states to collaborate in prosecuting firms or individuals in an effort to enhance enforcement. For example, the 6th MLD prescribes that where a money laundering offence has occurred within the jurisdiction of more than one member state, the member states involved have to cooperate in deciding which member state should prosecute it. The 6th MLD provides factors for member states to consider when determining this. These include where the offence was committed, the nationality or residency of the offender, the country of origin of the victims, and the territory where the offender was found. It's interesting to note that the UK has decided to opt out of complying with the 6th MLD on the basis that, in the UK government's view, the UK's domestic legislation already goes much further. Any UK businesses operating in the EU will, however, be required to comply with the requirements of the 6th MLD. Singapore has also passed legislation, the Payment Services Act of January 2019, which requires entities providing virtual asset dealing or exchange services to be licensed by the Monetary Authority of Singapore. The detailed AML-CTF requirements applicable to licensees are being imposed by notices issued by the MAS under the Monetary Authority of Singapore Act. In Hong Kong, crypto exchanges which are licensed by the SFC are required to comply with anti-money laundering and counter-terrorist financing obligations under the Anti-Money Laundering and Counter-Terrorist Financing Ordinance and are specifically required to comply with any updates to the FATF. Recommendations relating to virtual assets, including INR 15, which I mentioned earlier. As I mentioned earlier, Hong Kong currently only requires crypto exchanges to be licensed if they trade at least one cryptocurrency that is a security or a futures contract under the definitions. However, it's currently consulting on introducing a new licensing regime which will require crypto exchanges to be licensed even if they only trade cryptocurrencies that are not securities. These exchanges will also be subject to AML and CTF obligations under the AMLO. As I briefly touched on earlier, money laundering and terrorist financing is a risk associated with cryptocurrencies, and understanding the trends in the use of virtual assets for these purposes is important in better understanding and effectively tackling these challenges. So what exactly do we know about the trends in money laundering and terrorist financing in relation to virtual assets? Well, the FATF has said that in most detected cases, generally only one type of virtual asset was used. Where more than one type of virtual asset was used, this typically involved the layering of illicit proceeds. Other than being used in money laundering activities and commission of predicate offences, virtual assets were also used in fundraising activities for terrorism and to evade financial sanctions. The most prominent typology observed in the detected cases was the use of virtual assets as a way of layering, possibly due to the ease of rapid transfer. Among the offences involving virtual assets, the most prevalent offences were narcotics-related and fraud offences. So what about the risk landscape? Well, the FATF has observed that the dominant trends in the virtual asset money laundering or terrorist financing risk landscape since June 2019 include the use of VASPs registered or operating in jurisdictions that lack effective AML or CTF regulation, and the use of multiple VASPs, local and or overseas, and the continuing use of tools and methods to increase the anonymity of transactions. These include the use of registering domain names and using domain name service providers which redact the identity of the true owners of the domain name. Both trends make it more difficult to track and trace the transaction trail. In response to the ongoing COVID-19 pandemic, FATF jurisdictions have also observed the increased use of virtual assets to move and conceal illicit funds. For example, in one case, there was a report of virtual assets being used to launder proceeds earned from selling COVID-19 medicines. The risk landscape has also been impacted by the increased use of stablecoins and the new proposals for the worldwide adoption and mass production of stablecoins. The FATF's main concerns are that mass adoption could lead to a substantial increase in the number of anonymous peer-to-peer virtual asset transactions happening through unhosted wallets, since peer-to-peer transactions that don't involve the use of a VASP or other AML-CTF regulated entity are not explicitly covered by the revised FATF recommendations. A rapid expansion in the number and value of transactions not subject to AML-CTF controls under the revised FATF recommendations would then present a material ML-TF vulnerability. Therefore, the FATF urges jurisdictions to analyse and address risk in a forward-looking manner and make sure that they have all the necessary tools and authorities in place before they're needed. Otherwise, enforcement can be challenging, particularly given the cross-border nature. So let me have a look now in more detail at the FATF's concerns from an AML-CTF perspective in relation to stablecoins. Firstly, anonymity. As with other virtual assets, anonymity is also a concern with stablecoins. In short, the concern stems from the fact that, as with other virtual assets, stablecoins have public, permissionless, and decentralized ledgers. Although the transaction ledger may be accessible and records transactions, the ledger may not record any customer identification information. As such, the FATF recommendations are aimed at dealing with these issues by placing certain AML-CTF obligations on VASPs, which then carry out these financial activities. Secondly, global reach. The global reach of stablecoins heightens the AML-CTF risks. With the tendency of stablecoins to be mass adopted, these risks can increase exponentially. While virtual assets are in certain circumstances used for cross-border transactions, the FATF report notes that this is not a widely adopted practice due to the fact that virtual assets are not recognized or adopted in many jurisdictions, but also in part due to their volatility. However, stablecoins seek to make payments faster, cheaper, and more efficient for cross-border payments and transfers. From an AML-CTF point of view, cross-border transfers are thought to pose a greater risk than domestic transfers. And as such, cross-border transfers are subject to additional AML-CTF measures pursuant to FATF Recommendation 16. For virtual assets, this is known as the travel rule, which mandates VASPs to maintain and exchange information regarding the originators and beneficiaries of virtual asset transfers. However, this travel rule only applies to transactions which involve a VASP or other AML-CTF entity and doesn't apply to unmediated peer-to-peer transactions through unhosted wallets. This issue is compounded by the lack of implementation of the travel rule, as I mentioned earlier. Thirdly, layering. The ability to quickly exchange between virtual assets numerous times has the effect of disguising the origin of the funds, which makes virtual assets susceptible to chain hopping. Simply put, chain hopping means where money is moved from one virtual asset to another and also moved across exchanges. This creates a complex track record or money trail that's almost impossible to track. This is equally a risk to stablecoins in situations where stablecoins can quickly be exchanged for virtual assets or fiat currency. Finally, potential for mass production. A criminal's ability to use virtual assets as a means of exchange depends to a degree on how freely available the virtual asset is and also how freely exchangeable the virtual asset is. Virtual assets may have characteristics that do not make them appealing for use by criminals, which include their unstable value, the fact that they may not generally be accepted as a means of payment, and their complexity of use. However, stablecoins are designed to overcome the value volatility issue associated with virtual assets. Also, stablecoins are being integrated into pre-existing communication and messaging systems, which will make them simpler and faster to use. These aspects of stablecoins make them attractive and more susceptible to criminal abuse. So how do the FATF recommendations apply to stablecoins? The FATF studied 5 of the largest stablecoins to gain an understanding of whether or not the FATF recommendations sufficiently cover stablecoins. From its assessment, the FATF concluded that its recommendations do sufficiently apply to entities involved in the stablecoin ecosystem. Entities within the stablecoin ecosystem will have AML/CTF obligations under the FATF recommendations if they meet the definition of a financial institution or a VASP as set out in Recommendation 15. Where central governance bodies exist within the stablecoin ecosystem, they will generally be obliged entities under the FATF recommendations in the same way as other entities in the stablecoin ecosystem, such as exchanges, transfer service providers, and custodial service providers. However, the FATF has identified some residual risks, and these include the risk associated with anonymous peer-to-peer transactions through unhosted wallets. That's software hosted on a device that allows someone to store and conduct transactions in convertible virtual currencies without the involvement of third parties. This can be distinguished from a hosted wallet, where the wallet receives, transfers, and stores convertible cryptocurrencies on behalf of account holders, typically done online or through a mobile app. Risks from weak or non-existent AML/CTF regulation by some jurisdictions, and risks associated with stablecoins having a decentralized governance structure. So that brings us more or less to the end. Thank you very much again for joining me today. As I mentioned earlier, this is the first of 7 webinars on cryptocurrency regulation. Part 2 will be on Friday the 15th of January, and we'll continue the discussion of virtual asset regulation and the FATF recommendations before turning to a detailed analysis of Hong Kong's domestic crypto regulation. I really hope you'll join me. You can find the link to register on our website. For those of you who have already registered, I'm looking forward to seeing you on the 15th. Thank you and have a great weekend.